Hey, good morning, everyone, and welcome to this. What do we got? Tuesday, October 24th, 2023 edition of Trading Places Live at EarningsBeats.com. I'm Tom Bowley, Chief Market Strategist here at EarningsBeats, and I'll be your host for the next 30 minutes as we prepare for the trading day ahead. A couple of announcements I want to make before we get started. I am going to be traveling actually on a plane all day tomorrow. Heading out to stock charts in Redmond, Washington. So I will be out as far as Trading Places Live goes for the next 2 mornings. So tomorrow, Wednesday, also on Thursday. So that's the 25th and 26th. There will be no Trading Places Live. Also, for our members, we normally have our 10 a.m. Wednesday live trading room. That has been canceled as well. Again, I will be on a plane, so not really practical to be able to keep that schedule. Good news, though, is once I'm out at stock charts on Thursday, I will be doing a Your Daily 5. That's a kind of a regular monthly spot that I do over at stock charts. I will be hosting that show from the stock chart studio. And then on Friday for the final bar, Dave Keller's regular 4 p.m. Eastern show that airs every single day of the trading week right after the market closes. I will be joining him in studio as a guest on Friday. So mark your calendars, Friday, 4 p.m. Make sure you tune in to that. You can just get on YouTube and search right around 4 p.m. Just search YouTube for the final bar, and you should see it coming up. Let's see, what else do we have? Well, because I'm going to be in Seattle, I'm not quite sure what my schedule is going to be out there. I'll be collaborating with the stock charts team on Thursday and Friday. So it's possible for those of you that are members at EarningsBeats. I don't know. I know for sure on Wednesday, I will not be doing a daily market report. So you will get a brief market update from John Hopkins, my partner. And Thursday and Friday are kind of iffy. I just don't know whether I'll have time or not. So just be flexible there, but it's possible you may just get a brief update from John if I'm not available to do daily market reports those 2 days, because not only am I doing the Your Daily 5 and the final bar, but I think they're also going to be interviewing me for a 1-hour show at some point. I don't know the timing of everything. And then, of course, we'll be collaborating and in a lot of meetings. So my schedule will be thrown off quite a bit here over the next few days. I just want to make sure that everyone is aware. Next week, starting on Tuesday, we'll get back to our regular Tuesday, Wednesday, Thursday Trading Places Live. And of course, we'll be back on Wednesday at 10 a.m. for our next live trading room, but that will be next Wednesday. Let's see, before we get into the market, this is going to be a special Trading Places Live because I'm going to spend some time talking about how we put together our model ETF portfolios. We will probably be doing that. We'll probably announce, we will be announcing the draft, the ETFs that are going to be in our model ETF portfolio for the next 3 months. We'll be announcing that later today in a webinar for members only. If that's something that interests you, if you invest in ETFs, first of all, you're going to enjoy this show because I'm going to show you a unique way to put together a really strong model ETF portfolio. So make sure you sign up. We have a 30-day free trial that you can where you can get started there. Let's see, what else do we have? Well, I mean, I think that's probably it. So why don't we jump in and I'll give you first the futures. Right now, we got Dow futures up 155 points, S&P 500 futures up 22.5. and the NASDAQ futures up about 80. So on a percentage basis, all of them up about 0.5%. Crude oil right now up about 0.25%, still hovering around that $85 a barrel, a little bit above that in that area. And then the U.S. 10-year Treasury yield yesterday opened at 5%. And then we saw that yield dropping all day long. Money was pouring into bonds, into that 10-year bond in particular. 10-year yield dropped from 5% down to 484. So dropped 16 basis points intraday. And that certainly helped provide a little bit of a lift for U.S. equities. I'm going to go ahead and show you what happened there right now. So today I'm just going to go through this market summary, but you can see the Dow Jones was down 190 points, but we did have a pretty nice recovery. We gapped down. That was when the rates were at 5%. Then we saw the yield drop consistently throughout the morning into the early afternoon. And that's when stocks rebounded, did very well. Later in the day, though, after the yield had dropped, it went flat for probably the last 2 or 3 hours. And when that went flat, it seemed to take all the air out of the bubble for the Dow Jones falling back down near the lows. But that was one of your weaker areas in the market yesterday. The S&P 500, if you pull that one up, you'll see that it was actually got up to about 42.55 or so intraday off of that earlier low, which was down around 41.90. So again, big recovery, but then it once again selling in the afternoon. The NASDAQ, actually, I'm going to skip over to the NASDAQ 100, which I follow more closely. That's tracked by the QQQ. That's the ETF that tracks the NASDAQ 100. Anyway, you can see the move down to about 14,430, 14,440, something like that. And then a big jump of about 300 points over the next 3 hours. Really strong move. But then again, last 2 or 3 hours gave some of it back. We did finish up on the NASDAQ about 0.3%, but you can see that was more the exception to the rule. One thing that I did notice, though, even though the S&P 500 ended up down yesterday, look at the VIX dropping 6%. It did finish over 20. And so this is something that we're going to want to keep an eye on and watch throughout this week. I think as long as the VIX stays above 20, we've got issues. But if the market, we're starting off with pretty good action here in futures, looks like we're probably going to open up right now. I got NAS futures up almost 0.6%. If we see morning strength again, chances are that VIX is going to be down below 20. If it's not, if the VIX goes up with the market going up today, then that probably is a signal that maybe we're not going to hang on to those gains. But if that VIX comes back down and sustains a move back down below 20, I wrote an article over the weekend on Sunday, actually, in my Trading Places blog. And if you didn't read that article, you should go back, because this 20 level on the VIX is really like a tipping point. We've seen during this secular bull market advance, and I'm going back all the way to 2013. Yes, I believe we've been in a secular bull market for the last 10 years, 10 and a half years, dating back to April 10th, 2013. That was the day that the S&P 500 finally cleared the tops from 2000 and 2007. So that was the confirmation. Some will go back with hindsight and say, yeah, but really started in 2009. That's when the S&P took off. Well, yeah, but why wouldn't you have said that it started back in 2003 at the end of the dot-com bubble? Well, because history tells you that we topped again in 2007 and we never made the breakout and we went back down again. Well, in 2009, you don't know if you're going to make the breakout. You could go back up, challenge that 2007 and 2000 high and not get through. So it's not until you clear it that you actually have confirmation of a new secular bull market. So that's when I count my start date. Anyway, since then, over the last 10 years, we've had a really nice run up in the market. And during this period, we've seen the VIX jump above 20 many times. I think my count was 36 when I went back. I actually rolled through the last 10 and a half years and found that the VIX made that break from the teens above 20 on 36 different occasions. And I think it was only 12 of them where things actually started, really escalated, even for just a short period. In the other 24, it was basically you hit 20 on the VIX, the stock market bottoms, the VIX comes down, and the S&P takes off. So here we are again at 20. Now, this is like 3-4 days now that we've been at 20 or above 20 on the close. So this is kind of like borderline. Are we tipping over and ready to make, one final push to the downside? At least in my view, it would be one final push. Or have we marked the bottom? Did we mark the bottom yesterday on the S&P 500 at 4190? Only the future is going to tell us that. I think we have to be careful this week because of history, but the VIX, I believe is pretty strong in terms of staying up at above that 20 level. All right. Let's keep moving because I got a lot to try and cover today in a pretty short period of time. But overall, you can see there were the small caps, mid caps certainly underperformed yesterday. And you can see on the S&P 600 small cap, we went down to a new low at the close. So small caps, mid caps, certainly the underperformers again yesterday. Looking at the sectors, communication services, technology, and consumer discretionary, the only three groups that were higher yesterday. Even though we reversed down and finished lower across most indices, once again, those three primary aggressive groups were leaders. It's telling me a story, and the story it's telling me is a bullish story. It's not just yesterday. We've seen growth outperforming value over the last 2 months at every asset class, large caps, mid caps, small caps. The growth stocks within each of those asset classes, growth has outperformed value. That did not happen at the end of 2021, heading into 2022. When the market is going to take a tumble over an extended period of time, Wall Street bails out of growth stocks. They bail out of offensive areas and move into defensive areas. Makes sense. When the market's going down, defensive areas normally don't get hit as hard. That's one of the reasons why I'm questioning this move to the downside and have been questioning it since it started. Now, there were cautious signals back in July that said, hey, we were going to head into a rough period. Doesn't tell us how long it's going to last. Doesn't tell us how far it's going to drop. It just tells us we need to be careful. And we've seen what's happened since then. But for me, it's more than just watching the S&P 500 go lower. It's about how are we going lower? Which areas are leading us to the downside? What about these intermarket relationships? And they're all telling me the same thing, which is this ain't going to last. So again, have we bottomed, or do we bottom, later this week? I can tell you that starting at the end of this week on Friday at the close, we have the most bullish period of the year starting historically. And this goes back since 1950 on the S&P 500. So a lot to look forward to if you're a bull, at least in my opinion. But I know there are a lot of bears out there, and we'll see what happens. Let's keep moving. 10-year Treasury yield. Get that update. You can see that big red candle tells me that we are likely to see lower yields going forward. In fact, I'm going to say we see 450 to 460 before we see a trip above 5. Might be a bold call because I'm talking about going back 25 to 35 basis points before it goes up 15. But that's what I think. I think that candle right there with a negative divergence, higher yields, lower PPO, I think that bodes for continuing move to the downside. So I believe we see 460. I'm going to just say 460. I believe we go down 25 basis points before we go up 15. We'll see what happens. Very little in the way of economic news out today. Later this week, though, we will be getting GDP. I think that's going to be interesting. The estimates are all over the place. I've seen estimates as low as 2.8. I've seen estimates as high as 6% for the GDP. And I believe the consensus is right around 4.1, something like that. And of course, the Fed's watching it. But let me tell you something. If inflation continues to move toward the Fed's target level and our economy strengthens, that's nirvana for U.S. equities. Absolute nirvana. So while everybody's fretting about what the Fed's going to do and fretting about these interest rates being around 5%, I'm just telling you, if we see increasing economic activity and we see no reason for the Fed to hike, like continuing drop in inflation, it will be nirvana. I believe we're going to see an explosion to the upside in the balance of the fourth quarter. That's just me. We'll see. S&P 500, you can see breaking down yesterday just below the prior low. Did finish above its open, though, so kind of mixed signals there. We're seeing, movement back to the upside today. One thing over the last 4 or 5 days, you can see we've been putting in lower lows and lower highs. In order to start an uptrend, you have to reverse that pattern. So that's step one, and what I'll be watching for today and throughout the balance of the week. NASDAQ, you can see also just testing. We did go down just below these prior lows. These false breakdowns can be your signal for a bottom. If this was a bullish historical week, I would be a lot more bullish this morning. I'm a little concerned just because of what I know about history and this week, but that was a pretty good move on the NASDAQ. Unfortunately, when you look at something like the IWM, you don't get those same warm and fuzzies. We went back down, closed near the low. We'll see what happens today, but so far, not everything is looking quite as good as the NASDAQ or NASDAQ 100. Transports continuing to move lower, broke down and actually finished near their low yesterday. So this was not a good group at all, finishing down 1.46% on the day. Let's keep moving. I want to go into chart of the day. First, if you're not already an EarningsBeats Digest subscriber, I implore you, I beg you to sign up. I've learned so much in the stock market over the last 40 years. And my goal in this EarningsBeats Digest is just to educate. Things that I've done, things that I've learned, just trying to pass it along, build a community. Let's take on Wall Street together kind of a thing. Name, email address, and a subscribe button. Do those three things. Name, email address, hit that subscribe button. I'll set you up. Monday, Wednesday, Friday, that's when the EB Digest articles come out. They're a very, very quick read. When I say it should be maybe EarningsBeats Digest chart as opposed to newsletter. It's just one chart, 2 paragraphs, always trying to teach things and reinforce some of the things that we've learned over the years. Anyhow, please be sure to sign up if you haven't already. We do a lot of free webinars as well. And when we do free webinars, we reach out to our EB Digest community. We offer up room instructions. You can come in, watch the webinar live. We'll send you a recording. So there's a lot of reason to be a subscriber there. No credit card required. You can unsubscribe at any time if it's not what you think it is or what you wanted it to be. No hurt feelings on my side. I'm just providing it for free. If you want it, great. If not, that's fine too. Today, I just wanted to show you, since I won't be around tomorrow, I've already done the EB Digest for tomorrow morning. So I'm going to give you a sneak preview right here. This is what we're going to have for tomorrow morning. This is TriNet Group, TNET. This is in the business training and employment agencies area of the market. And if I scroll down, this is how the group has been trading relative to the S&P 500. It's been awful. This has been one of your worst performers going back 2 years. Just consistent relative weakness in this group. And you know what? Here's a stock in the group, and it's been showing consistent relative strength versus its peers. And it's also been showing signs of accumulation throughout the last 2 years. So this is a pretty interesting chart, considering that it's now breaking out to new highs, or it recently broke out to new highs in a group that has been awful. So I like leaders. Here's certainly a leader, TNET. This stock, look at the volume on this weekly breakout. There's these 3 candles right here to the upside. Those are very bullish in nature. Anytime you get this kind of a move to the upside, and look at the volume that accompanied this move to the upside. And this isn't just volume in a trading range. This is volume that's taking this stock up through areas over the last 2 years that have provided a lot of price resistance. 107 to about 112. If you look back, we had some volume going in here, and that's where we stopped at about, I don't know, maybe the 108 area. Then we came up here, got up to 112, closed the week out around 107. That was it. We went back, came back up and tested it the next month, and then fell back a little bit. And then finally, August and September, while the stock market was getting hammered, TriNet was absolutely exploding to the upside, setting new highs. Now it's pulled back. I like the stock down here around this 107 to 112 area. But let me just tell you, Wednesday after the close, today's Tuesday, so it's tomorrow, after the close, TriNet will be reporting its quarterly results. And so there's risk there for sure. But if they report good results and the stock manages to move back down into this 107 to 112 area, it's almost there now, that would be a pretty good buy signal for me. Of course, you have to decide for yourself. This has been a fast mover, so it's going to be an aggressive stock. You should be thinking about this as a very risky type of stock. So that might mean that, hey, you just stay away from it. Number two, it might mean that maybe if you do get it, you take a smaller position size. Or maybe three, you disagree with me and you think it's overbought and you just want to stay away, or even short it. Obviously, you can do anything with the stock. I like what's been going on in the chart, though. I really like this breakout. I think it pulled back down to that 20-week moving average. You can see that's where it bounced from back in July. Also bounced off of it in April and went just slightly below it back in March before bouncing. But basically, that 20-week moving average has been an excellent buy point over the last several months. And we're not too far from it. Just another few dollars, $3, $4, we'll be right back down there. Okay, so let's keep moving because I want to get through and talk a little bit about the way we put together these the model ETF portfolio. So I got about 10 minutes to talk a little bit about this. I'm going to show you an Excel. Actually, before I show you the Excel spreadsheet, let me show you our history. So if you go in here, you'll see right now our model ETF portfolio, because historically the market doesn't do well from the 19th to the 25th. And that's true of every calendar month, except maybe for December when we're right around the holidays. But most months, the 19th to the 25th is not a good period for stocks. Since 1950, the S&P 500 has an annualized return of -8% for all the days that have traded between the 19th and the 25th of the month, and including those days, 19th through the 25th. And you might say, well, that's only 6 days, 7 days. Well, it's 7 days out of every month. And months are anywhere from 28 to 31 days. So it's close to 25% of trading days in a month. But that makes it 25% or close to 25% of all trading days since 1950. All right. 25% of 73 years is 17, 18. No, it's 18, a little over 18 years. So probably somewhere in that 17 to 18 years worth of data. So think about if the stock market went down 8% every year for 17 or 18 years. Probably wouldn't be too excited about the stock market, would you? That's what takes place every month from the 19th to the 25th. When you add all those days together, that's essentially what it's done. A lot of people don't realize that, but it's really important. Anyway, when we're trading these portfolios, we get out on the 19th and then we go back in usually on the 25th. So I'm kind of monitoring it. We'll decide tonight. I'm going to announce the ETFs that we're going to have for the next 90 days. And I'll also give the allocation percentages. So obviously 100% is the total. So what percent in each one of the ETFs? There are going to be 8 ETFs. I've already selected them. There will be 8, and 2 of them will have 25% each. 4 of them will have 10%, and then 2 of them will have 5%. And that's what we're going to be riding with for the next 90 days. Again, that'll be announced later tonight at our model ETF portfolio draft event. And I believe that starts, let me tell you, I can tell you exactly when it starts. That will begin at 5:30 this evening, 5:30 Eastern. All right. So anyway, if I go back over here, you'll see that our historical performance since we began, which was 3 years ago, just actually almost, we just passed our 3-year anniversary. Our performance is 23.52. The S&P has been up 23.06. So only a slight gain there. But I do want to tell you this. From February to May of 2021, we lost to the S&P 500. We were 9 percentage points below it because that was the quarter we had just drafted in February of 2021. And that was the quarter when inflation absolutely skyrocketed almost right after we got into those ETFs. And so that quarter, all of our growth ETFs, which we were pretty heavily invested in, were crushed. We lost to the S&P by 9 percentage points. We have made it all up over the last 2 years. And if you try to put together an ETF portfolio, which is already widely diversified, and you try to beat the S&P 500, I wish you the best of luck. We've beaten it by more than 9, probably close to 10 percentage points over the last 10 quarters. We did lose to the S&P 500 last quarter by about 2 percentage points, maybe 1.5%, 2%. But prior to that, we had beaten it 3 quarters in a row and 5 of the last 6 quarters. And I believe 8 of the last 10, but it might have been 7 of the last 10. I'm not sure. Anyhow, my point is we've done a really good job on, because what we do is we go through and we decide what our themes are going to be. Part of that is looking a little bit at history. So let me give you an example before I show you the spreadsheet. One of the things I do is I just look at all the sectors on the, in terms of seasonality over the next few months. And one group, the industrials, and then I'll bring them up relative to the S&P 500. And I'll go back 11 years. And I go back 11 years because remember, the bull market, the current secular bull market began, like I said, April 10th of 2013. So what I'm doing is looking to see during the secular bull market, how these various sectors have been trading throughout the month relative to the S&P 500, or I should say throughout the calendar year by month, and how they're doing it relative to the S&P 500. Look at November, which is right around the corner. 1 week, November starts. Industrials, 9 of the last 10 years have beaten the S&P 500 and averaged beating the S&P 500 by 1.7 percentage points. And even if we throw in December and January, which have not been as strong for industrials, we still see a beat of about 1.2% on average over the next 90 days. So industrial seem like an area that I would probably want to overweight just based on the historical norms. Now, a lot of times we'll see in this time of the year, some of the technology names take a break. But if you go back 11 years, they haven't been horrible. And you can see November actually has outperformed the S&P 500 7 out of 10 years. December, 5 out of 10. And then January, because we've already had January of 2023, it's actually 11 years. But anyway, of those 11 years, we have, I think that's 7 out of 11 that comes to 64%. So 7 out of 11 years, December's outperformed, or January is outperformed in terms of technology versus the S&P 500. And if you look at the average gains, +4 flat and plus 0.6, if you add this, technology also outperforms by about 1% on the S&P 500. So just without knowing anything else, of course, I'm going to look at the technicals as well. I'm going to pull up the XLK, and I'm going to see what the XLK has been doing there. Also, what I'm going to do is I'm going to pull up the relative strength sectors and just to see what's going on right now. Here's technology relative to the S&P 500. It's been going up. It's sitting near an all-time high right now. Technology, even though it's pulled back over the last couple of months, it's essentially outperformed since the beginning of August. It's been outperforming the S&P. So while everybody's telling you to be scared about higher interest rates, money is actually rotating into the area that would likely be hardest hit if interest rates keep going higher. So what is this telling me? It's telling me while everybody else wants to sell these stocks, we've got some happy Wall Street buyers. Some of those big firms out there gladly taking your shares. Why? Probably because interest rates are not going to stay up. And we're going to have, like I said, a big move to the upside, and Wall Street's preparing for it, whether you realize it or not. Anyway, I go through all of this, all these sectors and industry groups, looking at relative strength, trying to determine which areas I want to be a little bit more heavily weighted in. All right. Now, with some of that background, got just a few more minutes here. Actually, just 1 more minute before the market opens, but I'm going to show you. I'll make it pretty quick. All right, here we go. So here is what we do. This is what we call our ETF Analyzer. So I start off by running a scan at stock charts, looking for ETFs that meet certain volume requirements because I don't want them to be illiquid. Sometimes the bid and the ask can be crazy. So I want them to be fairly liquid. I want these to be somewhat top performers. So I think I used the scooter at the stock charts technical rank had to be over 70. So it just tells us that these are ETFs that are in the top 30% of ETFs that are out there in terms of relative strength. I also put in a filter in there that the PPO on these ETFs has to be stronger than the S&P 500. So the PPO on the S&P 500 when I ran the scan was a little bit lower than minus 0.5 on a daily chart using the default 1226 reading. So these all had to have PPOs that were better than, higher than minus 0.5. So they could still be minus, but they just had to be barely minus, or their PPOs had to be in positive territory. And I also took out any international. We don't do international. Don't come. You really don't want to come to EarningsBeats for international work. I can just tell you, I'm not an expert in areas outside the U.S. It's not what I focus on. I don't understand their political climates. I don't understand their business climates. I don't understand their oversight. I don't understand a lot of things in all the various countries. So I really try not to limit, or I try to limit what I do to the US. Also, I'm not going to try and be a bond expert. If you want to put money in bonds, find somewhere else to put your money in bonds. All I do is look at stocks. So I'm taking out all the bond funds, both corporate, treasuries, any kind of bond fund. I'm taking it out because that's not really what we're focused on here. We're looking for stocks. And so if you wanted an ETF portfolio that focuses on stocks, let's say you've got, your 100% of all your investments, and let's say you decide I only want 50% in US equities. Okay, well then that 50% is what you might consider for what we do in our ETF portfolios. But all of these portfolios all of these ETFs are laid out that met all the retirement, or all the filters and everything that I put into the scan. These are the ones that resulted and survived. There's 65 of them. Actually, I think there were about 59 or 60 of them. I made sure all of the sector ETFs are included. I always have the top, or those 11 sector ETFs, materials, XLB, consumer discretionary, XLY, and so forth, all 11. Just in case I want to fill out a portfolio and I want to get more of a certain area of the market, I can then just put a certain percentage in for those individual sectors, and I can decide, I can get to where I want to be. Because what I normally do is I'll decide, here's how the S&P 500 right now lays out relative, each industry group, or each sector, their representation in the S&P 500. So this is what we have right now. And so what I normally do is I'll say, okay, technology, if I want to outperform the S&P 500 and I like technology, maybe I'm going to want 35% technology. Maybe discretionary, I might want 12%. Maybe I don't like communication services. Maybe I want 3%, and so on and so forth. And I can go on and just say, okay, what are my targets? What would I really like to have if I could just kind of package this thing up beautifully? And I'll fill all that out. And then what I'll come down and do is I look at each ETF, and it's broken down. The ETF is telling, this ETF analyzer tells us how each ETF is broken down into the 11 sectors. So we do a lot of research here. And so if you want to find something hot, very, very concentrated, look for something like this BUG, BUG, where cybersecurity is the only thing it's invested in. So it's going to be 100% in technology. This top 10 holdings here tells you how concentrated or diversified it is. So the top 10 holdings of the Global X Cybersecurity ETF, top 10 holdings are 60% of the ETF. So not only is it all in cybersecurity, but 60% of it is in 10 stocks within cybersecurity. This is a risky ETF. But then you have others that have much lower percentages. I don't have any of them, I don't think, under 10. Sometimes I'll have under 10. But here's one that's 20. Here's one that's 19, the JP Morgan US Quality Factor. Top 10 stocks there, only 19%. And it's pretty widely diversified. I mean, if you're just looking at those numbers, pretty much, pretty close to the S&P 500. So this could be a core holding because it is a little higher than the S&P there. It has S&P's representation of technology is 26%. This one's 29. So if you use this as one of your core holdings, you're getting a little bit more toward technology. One more thing that I'll point out though, and by the way, you could go in and start putting your percentages in, 20% here. Let's say energy, you really think energy looks good, and you want to put 5% directly in there. And then, I'm just going to do it. I would never put 70% in any of these, but let's just say you wanted to put 70%. I'm doing this because these totals are added up here and become 95%. It's telling you there's an error. So we have a built-in error. You have to make sure your allocations total 100%. So if I did that and I was like, oh, well, let me make this one 25%. Now it's 100%. There's no error. And here are your results. So now it's telling you, based on your selections, 71% of what you're investing in is technology. Is that really what you mean to do? Do you really want, if technology goes down the next quarter, you're going to get hammered in this ETF portfolio, if this is your portfolio. So, maybe you might want to say, oh, I better be careful. Maybe I just want 10% in there. And maybe there's another widely diversified. Here's one. This is the iShares Core US Growth. Maybe I'll put 60% in there. So now you're back to 100%. And now you got a little bit better. Your numbers are a little bit better there. More, a little closer to the S&P. So the whole point is you can get to what you want by using this ETF analyzer. One last point, and then we'll wrap this up. Top 10 holdings. When I say that this group right here, let's say 60% cybersecurity, if you go to the top 10 holdings tab, it will tell you, here are your 10 stocks. There's your 60.5%. And here are the 10 stocks that make it up. You can go in and look at those stocks, look at their charts, see if, do you really want a lot invested in this ETF? If you look at the chart of ZS, which is Zscaler, and let's say that it's a horrible looking chart. Do you really want a big portion of your money going into an ETF that has 9% of it in Zscaler? So what I always say about these ETFs and having an ETF portfolio, know what you own. Know what you own. That way, at the end of 90 days, you don't just sit back and say, well, my ETF had a bad quarter. Well, you should know why your ETF had a bad quarter. You were invested in the wrong areas of the market, or your ETF, maybe it was in the right areas of the market and just had all the wrong stocks. Do some research. Actually, we've done it for you. As a member at EarningsBeats, you'll get our ETF Analyzer spreadsheet, and you can go in and do your own calculations. And if you want, you can even go down here and add your own ETFs. Go through, do the research. If there's ETFs out there that you think, hey, I want to own these, list them. Do the homework. Fidelity will break it down for you if you have an account at Fidelity. I think even the Yahoo Finance, I think you can go back and find this information. Break it out. Put your percentage in. Find out what you own. All right. Let me just go in. Let's see where the market is, and then we'll wrap this thing up. All right, so let's go to the dashboard. And yep, we got the market moving higher, about looks like 0.75% across the board. Right now, the Dow, you can see quickly right back up to the high yesterday. S&P 500 just below that high. I'm going to be watching to see if we can get through these highs. That'll be step one. Small cap still lagging a little bit. Same thing there. VIX back down below 20, moving to a new low, or at least testing the low from yesterday. So far, things looking pretty good today. We do have a lot of big earnings reports coming out later this week. Tonight after the bell, we've got Amazon and Google. Tomorrow after bell, we've got Meta. So there are some big ones that will be coming out. Make sure you check all of that out. I love the market to go higher. My position is I'm just slowly building into a position. Personally, I'd love to see the market go down a little bit more just so I can average in a little bit lower. But I love the market. I think we'll go higher into the fourth quarter, the balance of the fourth quarter. And I think it might surprise people how much it goes higher later in the fourth quarter. But anyway, that's where I stand right now. Again, no Trading Places live tomorrow and Thursday. No Trading Places live or no live trading room Wednesday at 10 a.m. Eastern for members. I will be traveling out to Seattle, Washington, actually Redmond, meeting with stock charts. I'll be doing hosting, or not hosting, but I'll be doing a little bit of hosting. I'll also be doing some guest appearances on a couple of different shows while I'm out there. Friday at 4 p.m., the final bar, that's 4 p.m. Eastern. I will be joining Dave Keller live in his studio. So I'm really looking forward to that. Make sure you tune in there. I'll be doing a Your Daily 5, which I do once a month. I'll be doing one of those, I believe, on Thursday. So that should probably be released sometime on YouTube, sometime probably early afternoon, I'm thinking. So be on the lookout for that. You can go to YouTube and just search Your Daily 5 Tom Bowley. And once the new one comes up, you'll be able to listen in on that, where I'll share 5 charts that I think are really important. And then they're also going to be interviewing me probably. I think it's an hour interview while I'm out there. So that will be airing soon. I don't know what the timing is for that, for the airing of that episode. But anyway, that's it. Looking forward to my trip out to stock charts. I'll miss doing the shows here over the next couple of days, but I will be back next Tuesday. Hopefully with a much more bullish market, much stronger market. We'll find out on that. Anyhow, everybody have a great day. Enjoy the rest of your day. Enjoy the rest of the week. Let's see how this market goes. Watch the VIX. Let's see if we get some turnaround, a little bit of maybe higher highs, higher lows would be nice. That's what we need to really get this thing going. Anyway, have a great day, everybody. Happy trading.